That tiny $800 scratch on your bumper? It's actually a rigged trap that quietly costs the average driver up to $17,500. And your insurance company is banking on the fact that you have no idea how the math works. You've been there. You're at a red light, someone taps your bumper, there are no shattered glass or airbags, just a scuff. You exchange info, skip calling the cops because it feels minor, and figure it's just $800. 6 months later, you open your insurance renewal notice and your stomach drops. Your premium didn't go up by a little, it went up by a lot, and it's going to stay up for years. So how does an $800 fender bender turn into a 5-figure problem? Here's the math nobody actually shows you. The sticker price you see at the body shop is basically bait. It's the smallest number in the whole equation, and it's the only one anyone thinks about in the moment. The real number, once you add up the repair bill, the deductible, a rental car, 3 years of jacked up premiums, and the hit to what your car is actually worth on a resale lot, lands somewhere between $3,400 and $17,500 for one fender bender. One. And that's before we even get to the possibility that your neck starts hurting 2 weeks later. Start with what you actually notice right away. Say the shop quotes you $800 for the repair. Sounds simple, right? Except your deductible hits first, anywhere from $500 to $1,000 depending on your policy. This is where your collision coverage actually kicks in. Collision is the part of your auto insurance policy that pays for damage to your own car after an impact, regardless of fault. So before insurance pays a single dime, you're already out real money just to unlock the coverage you've been paying for. And if you've been driving with liability insurance only, which covers the other guy but not your own car, you're paying that entire repair bill yourself. Then there's the rental car. The average person is without their vehicle for almost 2 weeks after an accident. Insurance will usually cover a rental, but it comes with a daily cap, something like $30 to $40 a day. Rental prices right now run anywhere from $12 to $86 a day, depending on where you live. And when your rate runs higher than your cap, you're covering the difference out of pocket every single day for 2 weeks. Add it all together, and week 1 alone, repair, deductible, rental gap, can already push $1,500 to $2,000. And that's still the cheap part. Here's where it gets ugly, because your insurance company isn't done with you, not even close. The average driver sees their premium jump 50% after an at-fault accident. Some carriers, Progressive for one, have been documented raising rates by over 100%. In real dollars, that's often the difference between paying around $2,000 a year and paying nearly $3,000 a year for your coverage. And it's not a one-time penalty. That surcharge sticks around for 3 to 5 years, so one bad afternoon at a red light quietly costs you somewhere between $1,500 and $2,700 in extra premiums before it finally rolls off your record. One thing worth knowing here, some insurers offer accident forgiveness programs, which can shield you from that first rate hike. It's worth checking whether your policy includes it, because most people don't find out until it's too late. Also, if you live in a no-fault state, the rules change. In no-fault states, your own insurer pays your injury costs regardless of who caused the accident, which affects both how claims are filed and how premiums get recalculated. At-fault versus no-fault state laws are one of the most overlooked factors in understanding why your neighbor's rate increase after the same accident might look completely different from yours. Here's the part that really gets people. It's not even just the driver who caused it. If you're the one who got hit and it wasn't your fault at all, your rates can still climb. Not-at-fault accidents bump premiums an average of 12%, just for being in the wrong place at the wrong time. Now here's the one almost nobody knows about until it's too late. Diminished value. Even if the shop does a flawless repair, paint matches perfectly, panels line up, drives like nothing happened, your car is now worth less, permanently. The second that accident hits your vehicle history report on Carfax or a Clue report, that's the Claims Loss Underwriting Exchange, a database insurers use to share your full claims history. Buyers see it and they pay less for a car that's been in a wreck, no matter how clean the repair was. Kelley Blue Book and other appraisal tools factor accident history directly into valuations, which is why that loss hits harder than most people expect. A car worth $22,500 before the accident might only appraise for $18,000 after, even with a perfect repair. That's $4,500 gone, just like that, logged permanently into LexisNexis Risk Solutions through the Claims Loss Underwriting Exchange, known as a CLUE report. Most insurance companies calculate this using the infamous 17C formula, a methodology born out of a Georgia court case that caps assumed vehicle value loss at 10%. Behind the scenes, insurers feed these metrics into systems like ISO ClaimSearch to track every payout. Attorneys who fight these claims for a living will tell you insurers do not make this easy. As one Florida attorney who works these cases put it, it's a real fight to collect on what you're actually owed. Most people never even file for it, which means most people just eat that loss. And then there's the cost nobody sees coming, because it doesn't show up on day one at all. Whiplash and other soft tissue injuries can take days to appear. You walk away from a low-speed fender bender feeling completely fine, and then a week later, your neck won't turn and you've got headaches that won't quit. This is exactly what personal injury protection, or PIP coverage, is designed for. PIP pays your medical bills regardless of fault, but not every state requires it, and not every driver carries it. Minor whiplash settlements typically run $2,500 to $10,000, and nationally, the median payout across whiplash cases sits around $7,500. That's not rare. That's the middle of the pack. Suddenly, your $800 accident has a medical bill attached that dwarfs the original repair. This isn't a problem that's stayed the same size over the years either. It's actively getting worse, and there are a few specific reasons why. As consumer advocacy research from the Insurance Institute for Highway Safety demonstrates, this isn't a random glitch. It's a structural shift in modern risk management, and it's actively getting worse. Cars are dramatically more expensive to fix than they used to be. The average repair cost hit nearly $4,800 in 2025, almost double what it was in 2010. A huge chunk of that comes from the fact that modern vehicles are packed with complex electronics. Backup cameras, parking sensors, and advanced driver assistance systems, known as ADAS, mean over a third of repair estimates now require precision recalibration after even a minor hit, with each system adding $350 to $500 just to reset. Under the policy frameworks tracked by risk analysts, a bumper tap isn't just a bumper anymore. It's a bumper and a computer. The fleet is also aging. The average car on American roads is now over 12 years old, and older cars are worth less, which means it takes a lot less damage to total one out completely. Insurers would rather write you a check for the car's value than pay to fix it, and that's exactly what's happening. In 2025, nearly a quarter of all insurance claims ended in a total loss, the highest rate in industry history. A fender bender that would have been a routine trip to the body shop 5 years ago can now total your car outright. So here's the question this all builds to. For something truly minor, should you even go through insurance at all? If the damage costs less than your deductible, the math basically makes itself. You're paying either way, so just pay the shop directly and skip involving your insurer entirely. But even when an insurance claim technically saves you money up front, it can trigger years of higher premiums that cost far more than what you saved. That's actually why a J.D. Power study found that 7% of drivers flat out avoid filing claims. They're scared of what it'll do to their rate. It's also why a lot of financial advisors now recommend raising your deductible on purpose to $1,000 and keeping a separate repair fund. It sounds backwards, but it can save you $200 or more a year in premiums, and it keeps small dings from ever touching your insurance record in the first place. So the next time you tap a bumper at a red light and think it's just an $800 fix, remember the full financial stack: your collision deductible, the daily rental car gap, 3 to 5 years of insurance surcharges, permanent diminished value recorded on your CLUE and Carfax history, and delayed soft tissue injuries covered by PIP. That initial estimate was never the real cost. It was just the entry fee. If this breakdown opened your eyes to how auto insurance claims actually operate, smash that like button, drop your own fender bender story in the comments, and subscribe to Policy Shock so you never get blindsided by your next policy renewal.